Today we're looking at another business development company, or BDC. This one's suggested by Danny Yo-Yo. Be like him, subscribe. After performing the stock analysis on Goldman Sachs BDC Incorporated, stock ticker GSBD, we will be comparing it to last week's stock in question, Main Street Capital, so stick around till the end of the video for that outcome. The Goldman Sachs BDC is currently trading at a share price of $18.98 with a market cap of $1.931 billion. The 52-week range of $14.89 to $20.65 expresses they are currently 8.09% cheaper than this year's high, and a beta of 1.52 signals that GSBD's share price is subject to larger price fluctuations than their underlying index. They have most recently missed on their quarterly earnings per share estimates by 2 cents, but had a strong showing through 2020 thanks to some smart management, which we will discuss later. GSBD's earnings per share of $3.79 does result in a PE ratio of 5.01, which is favorable as it is one of the lowest among their peers. You need an overview on how BDCs function in order to generate shareholder distributions. You can check out my last video on Main Street Capital. It's in the beginning of that. Just don't forget to come back. The Goldman Sachs BDC primarily invests into middle market companies whose businesses may be struggling to generate revenue, so GSBD themselves can produce shareholder returns. The dividend rate of 9.56% will give you an annual payout per share of $1.80 paid quarterly. Additionally, GSBD has a wonderful payout ratio of 89.73%, but has not seen any dividend growth. This is by design, however, as the company has distributed the same annual amounts since inception, with the addition of 3 special dividends thus far in 2021. Although I generally like to place some priority on the dividend growth rate of my investments, I believe this is one of the reasons why GSBD has been able to keep that payout ratio in such a favorable place, and is quite refreshing given the large risks that BDCs will be facing given the economic climate and rising interest rates. With a price to book ratio of 1.16, GSBD's market value is just slightly larger than their book value, signifying this may be an ideal time to invest. The company currently has $119.29 million in total cash on the balance sheet, with $1.58 billion in debt and an operating cash flow of $489.78 million. Although their debt levels are much larger than the cash on hand, GSBD's short-term obligations are currently of no concern, communicated by the current ratio of 1.5. Taking a closer look at their debt shows it is mainly supplied by revolving credit facilities at a rate of 63%, and a vast majority is set to mature after 2025. Although the fixed interest rates listed are quite low, most of their debt is subject to variable interest rates set by the London Interbank Offered Rate, or LIBOR. I believe this is another factor which makes GSBD a slightly safer investment than their BDC peers. LIBOR is calculated by the Intercontinental Exchange, or ICE, and represents the average cost of borrowing from large financial institutions across the globe. The reason LIBOR may offer GSBD some more safety than the US federal rate is because it is not calculated by a specific market mechanism, and this has been shown historically by divergence between LIBOR and the Fed's rate during 2008 financial crisis. Goldman Sachs BDC Inc. has reported profit and operating margins of 115.74 and 79.15% respectively, and management has proven to be on top of things again with a return on assets of 5.64% and a return on equity of 28.58%. These strong returns are more than likely the reason that GSBD has been able to increase their net asset value per share by 5 cents in just Q2 of 2020, thanks to the 57-cent per share increase of the adjusted net investment income, or NII. This was driven by $3.533 billion in total investments and commitments spread across 114 companies, which are further diversified fairly evenly into a multitude of different financial industries, with the largest in healthcare technology and software at 11.6 and 9.8% respectively. Furthermore, GSBD management has been increasingly busy since Q4 of 2020, adding millions of dollars in new investments to their portfolio. Q2 of 2021 alone has resulted in the addition of $368.8 million in new investment commitments, and did not impede Goldman Sachs BDC too much, as they also received $277.4 million in sales and repayments in the same quarter. These large investment opportunities should not be taken lightly, as they really did result result in a resourceful play by GSBD management. October 12th, 2020, Goldman Sachs BDC merged with Goldman Sachs Middle Market Lending Corp., allowing them to take advantage of the economic climate with non-existent interest rates. Not only did this significantly deleverage GSBD, but it also more than doubled their asset base, which has allowed them greater income to purchase more investments. GSBD has given me multiple reasons to believe in their conservative management style, winning me over with careful practices through a rough economic climate. But do they beat out the ever so popular returns of Main Street Capital? The market caps of GSBD and Main are slightly different at $1.931 and $2.861 billion respectively. If you were to invest an initial amount of $10,000 into each company while reinvesting dividends and without any additional contributions, your Main investment would have doubled, while the Goldman Sachs BDC has just grown $6,654. This is exemplified by the compound adjusted growth rate, or CAGR, difference in Main's favor of 5.36%. If you've watched my video on Main, this should not be utterly surprising to you, as they really do pride themselves on returning every last bit of their earnings to shareholders with a payout ratio of 103.28%, while GSBD has consistently paid the same distribution since inception. Although this may not seem great for your ideal return on investment, it's important to keep in mind that this portfolio growth model is only illustrated during a bull market. If GSBD truly is a safer BDC, as we've discussed and conveyed by the annual returns in 2020, then maybe it is more advantageous to hold GSBD in a market with high volatility and increasing interest rates. The most surprising part of this comparison to me is the income which each investment would have generated over the same 6-year period. Although many people would choose Main over GSBD simply for their monthly dividend payouts, GSBD was able to keep up quite nicely, even paying out much more in the major drawdown year 2020. Now, which one is better, you ask? As always, when we do these stock analysis videos, it depends. It depends. It depends. It depends mainly on your portfolio diversification, what positions you already hold, and the weighting alongside them. It depends on what you want your investment to accomplish, the time frame you are willing to hold, as well as your risk tolerance. Maybe you're already invested into many high-yield companies with large amounts of leveraged debt, such as real estate investment trusts. In that case, the Goldman Sachs BDC may be a better option than Main. On the other hand, a portfolio which primarily holds large positions in broad market, exchange-traded funds may benefit more from the monthly dividend payments of Main Street Capital. I want to hear what you think in the comments below, so drop your preference between the two. Let's jump to the 1-year chart. Trading at a share price of $18.98, the Goldman Sachs BDC upward price trend has begun to level out, shown by the gray 200-day moving average line. Furthermore, the price is currently dropping and in a short-term bearish trend, which is conveyed by the share price being stuck under the red 20-day moving average. With that being said, however, the 3 analyst ratings resulted in an average low market value of $19, which currently exceeds the share price. To sum it all up, I am pleasantly surprised with the fundamental analysis as well as management effectiveness of GSBD, the Goldman Sachs BDC. After reviewing their BDC peers, PSEC and Main, check those videos out if you haven't seen them already. I do believe GSBD to be a safer option while not drastically hampering any of the income you may receive. I hope you found this analysis helpful today, and feel free to subscribe to the channel for more videos just like this. As always, I'm Patrick Zimmerman. Thank you for your time. Have a nice day.